Good morning, friends. My name is Rajat, and today I'll be discussing all the customs law relating proposals made in the Union Budget 2021. After that, Ms. Shweta will take all the GST related changes, and finally, we'll have Mr. Dipanshu who will be dealing with all the direct tax changes. From a customs law point of view, I feel that the present budget is a mixed budget in the sense that it has something for all the stakeholders involved, in the sense that you have provisions which give additional power to the customs authority to confiscate goods and impose penalties in certain additional situations which are right now not covered by the Customs Act. At the same time, you also see provisions wherein accountability has been fixed on the customs department to undertake certain actions in a timely manner. Having said that, I also feel that there are certain provisions in the Customs Act, the proposals which they've made, there is a bit of lack of clarity, and more clarity would have been welcome in those areas. This part we'll discuss in detail when we have a look at the exact changes which have been proposed in the Union Budget as far as the customs law. Lastly, we also feel that the Honorable Finance Minister has missed out on certain aspects or certain opportunities, especially before the introduction of the Union Budget. It was widely anticipated that custom amnesty scheme will be introduced to settle all pending litigations under the Customs Act and all pending disputes, especially considering the fact that in the previous few budgets, we saw a similar amnesty scheme being introduced to take care of and settle all the pending litigations and disputes under the erstwhile excise and service tax law and existing income tax law. So this amnesty scheme has not been introduced as far as the customs law is concerned. Only time will tell whether or not such a scheme is introduced after the budget or not. With that brief background, let's have a look at the exact changes which have been proposed in the Union Budget. First, we'll have a look at the changes made or proposed in the Customs Act. Firstly, friends, they have introduced a sunset clause or a time limit or a validity period for all conditional exemption notifications. We need to bear this in mind that this time period or this validity period has been provided only for conditional exemption notifications. Unconditional notifications will not have this time frame or this validity period. Now, the time period which has been prescribed is for all existing notifications which have been issued prior to the passing of the Finance Bill 2021. All those notifications will discontinue automatically after 31st March 2023. So after this point of time, unless there is a notification extending the validity of the conditional notifications, all the conditional notification, existing conditional notification will get automatically expired after 31st March 2023. In respect of future notifications, they have provided that future notifications which are issued after the passing of the Finance Bill 2021, those will expire automatically after 31st March, falling immediately after the expiry of 2 years from the date of issuance of notification. Meaning, so if hypothetically a notification is issued in the month of, let's say, October 2021, then the notification, the conditional notification will automatically get discontinued after 31st March 2024. That is 31st March falling immediately after the expiry of 2 years from the date of issuance of notification. So going ahead, all businesses should have a look at all the notification, conditional notifications which they are availing benefit of, and take a conscious decision considering the fact that after a 2 years or 3 year period, the same may get discontinued. The idea behind this provision is, as the Honorable Finance Minister in her speech also mentioned, that there are number of notifications which are in place, conditional notifications which have become irrelevant. So for them to rationalize all the existing conditional notification, they have put a validity period for all such exemption notifications. Even though it's for the objective of rationalizing all the notifications, the catch which we see is that it will increase the workload of the government, because they will have to keep a track of all conditional exemption notifications which they want to extend over a period of time. Because in conditional exemption notifications also, we have notifications such as FTA notifications, or notifications where exemption is made available at the time of reimport subject to certain conditions. So these notifications in our view will continue despite the validity period of 2 years which has been provided, and the government will have to keep a track. So this may have some problems in cases where there is no timely reissuance, or where validity of the existing notification is not enhanced. Next is, like I mentioned, that time limit has been prescribed for completion of all customs investigation and inquiry which lead to issuance of show cause notice. In this, a time limit of 2 years has been prescribed, which is further extendable by 1 more year. So a maximum period of 3 years has been prescribed for completion of all investigations or inquiries under the Customs Act which lead to issuance of show cause notice. The only catch, there are two aspects which we feel have not been clarified clearly. The first aspect we believe is they have not clearly specified as to at what point of time it will be deemed that the time period of 2 years or 3 years has started. Will it be at the time of issuance of summons or search, or when they write a letter to the SSE asking for certain information? So a lack of clarity, utter lack of clarity as far as this aspect is concerned. So even though it's a beneficial provision which has been introduced so as to take care of all the existing investigations, where the investigations continue for a long period of time, leading to unnecessary and completely avoidable mental agony and harassment to the SSE. But having said that, on account of this lack of clarity, this provision may not be that beneficial to the SSE unless it is so clarified. Second aspect which we feel is that they have not specified as to what will happen in those situations where this time limit is not adhered to. Let's assume the investigation is not completed within a period of 2 years or 3 years, as the case may be. What will happen? Because why I'm saying so is, if we see this provision along with section 28, existing section 28 of the Customs Act, where time limit has been prescribed for completion of adjudication proceeding, issuance of adjudication order, there they have very well clearly written that if the time limit of 2 years or 5 years is not adhered to, then the proceedings will abate and it will be deemed that the proceedings have been concluded in favor of the SSE. But in the new provision where they've given a time limit for investigation, that part of it, that consequence has not been provided. So there is a possibility that the Customs Department may argue in a given case that this is only a general or an indicative timeline. So even if they don't adhere to this timeline, no consequence will arise. But having said that, again, the objective behind introduction of this provision is that wherever the investigations are not completed or inquiry is not completed and show cause notice is not issued within this time frame, the proceeding should abate and no further demand should be made against the SSE. Lastly, one more point I would like to highlight is they have clarified that this time limit will not apply to investigations which have been initiated prior to passing of the Finance Bill 2021. So it will apply prospectively for all those investigations which have started after the passing of Finance Bill 2021. Next interesting change which they have made is they have revised the timeline for filing of bill of entry to avoid late presentation charges. Right now, a period of 2 days is available to file bill of entry, in the sense that if the goods arrive at the customs port today, you have end of date tomorrow to file the bill of entry. That is end of the following day of arrival of goods to file the bill of entry. After that, late presentation charges will start getting levied. But now they have proposed that this timeline will be revised to provide that bill of entry has to be filed in advance, in the sense that if the goods land at the customs port today, the bill of entry should have been filed maximum before the end of the preceding day. So if they land at the customs port today, you should have filed the bill of entry yesterday end of day. If you file it today, then you will have to pay late presentation charges for this particular date. So going ahead, all businesses, it is advisable they should take a hold of their bill of entry filing mechanism and ensure that after the passing of the finance bill, and if they can do it right away, it will be a welcome step, that they should start filing all their bills of entry in advance before the goods land at the customs port. Next is that they have given power to the customs authority to confiscate goods which have entered for export under wrongful claim of refund or remission. The idea behind this is they want they want this provision to act as a deterrent in all those cases where people file bill of entry, people want to export the goods, and along with the export of goods they file a refund claim or a remission claim, and the refund or the remission claim is wrongful or it is in contravention of the provisions of the Customs Act. Now, one interesting thing to note in this provision is that they have clearly provided that it can be in contravention of either the Customs Act or any other law for the time being enforced. Meaning thereby, if you export goods, if you file bill of entry and you file a refund claim under the provisions of the IGST Act, and that refund claim is in violation or in contravention of provisions of the IGST Act, in that situation also the customs authorities are empowered to confiscate the export goods and consequently impose penalty. So this even though this is meant to act as a deterrent for all such situations, but having worded it very widely, there is a large possibility of misuse of this provision. So only time will tell whether it is actually used by the authorities in genuine cases or it is misused by them in the cases where it is not meant to be invoked otherwise. Similarly, we see that a new penalty provision has also been introduced, which imposes penalty on fraudulent use of ITC for availing refund on export of goods. So the idea behind this provision is that if I take a invoice by fraudulent means, on that invoice I avail ITC. Using that ITC, I pay tax on my export goods and then avail refund of that export transaction. In such situations, they can catch hold of me under the Customs Act and impose penalty. Here, they have put a very onerous amount of penalty. The penalty can be imposed up to 5 times the refund amount involved. Again, the idea behind this provision is that all such cases, even though they are they are right now also punishable or penalty can be imposed under the IGST, GST laws, but still they have put this clause in the customs provision so that it acts as a deterrent, and people will have to realize that they can be punished and penalized both under the customs law and also the IGST law. So these two provisions are very dangerous. We'll have to see actually whether it is used by them or misused by them, but having worded them so widely, we will have to keep a track of both these provisions. Lastly, in the Customs Act, the board has been notified. Board has been empowered to notify Common Customs Electronic Portal. This is to facilitate and provide a platform for electronic registration of all stakeholders, importers, exporter, and other stakeholders, filing of bill of entry, shipping bill, and other documents required under the customs law and other laws at the time of import and export, and also for paying customs duty. So this is in furtherance of all the recent e-initiatives which have been taken by the board. Such as the very recent initiative of introduction of faceless assessment on the existing IceGate portal backed by RMS system, e-Sanchit platform, Swift platform. So this is only in furtherance of all those initiatives. And along with this, they have also specified that now there is a possibility for certain items, they may allow amendment of bill of entry by the importer exporter on this common customs portal itself. So this is a very welcome change. Additionally, I would also like to highlight one more important point in this regard, that they have revised the provisions under the Customs Act pertaining to service of notice, order or summons. Now they have provided that service of these documents will happen through common customs electronic portal also, meaning thereby if any summon is issued, any notice is issued or any order is issued, all those can be served to the SSC by putting it on the common custom portal, electronic portal itself. So this is again in the line with all the recent initiatives they have taken, and hopefully we'll see more such initiatives to further the cause of ease of doing business in India. Now let us have a look at the changes which they have proposed in the Customs Tariff Act. Uh, One very important change which they have introduced is that in the anti-dumping duty provisions and CVD provisions, they have introduced anti-absorption provisions. These anti-absorption provisions seek to counter all those situations where the anti-dumping duty and CVD is sought to be absorbed by the exporter in his price, so as to render anti-dumping duty and CVD redundant or ineffective in India. Hypothetically, I'll give you an example. So let's assume to protect the domestic industry in India, the Indian government imposes an anti-dumping duty of $2. Let's assume. After imposition of anti-dumping duty to the extent of $2, the foreign supplier reduces his price by another $2, so that the price at which the Indian importer gets the good remains the same despite imposition of anti-dumping duty. So as to take care of all such situations where the duties are absorbed by the foreign supplier in his price, they have introduced these anti-dumping provisions, which basically will allow the central government to increase these duties so as to protect the domestic industry in India. Another very important change which they have made in this regard is that they have now allowed the central government to put retrospectively anti-dumping duty and CVD in all those cases where these duties are sought to be circumvented. When I say circumvented, I mean in a situation, let's assume anti-dumping duty is imposed from all imports made from China. What Chinese importer will do is they will start selling their goods from Bangladesh or Sri Lanka to avoid paying this anti-dumping duty. In a way, they are circumventing the imposition of anti-dumping duty and CVD. So in all such situations, it has been provided that wherever such situation arises, the central government is now empowered to ask all the importers to have their assessments on provisional basis at the time of import, and secondly, they now can impose these anti-dumping duty, CVD duty at an increased rate from retrospective effect from the date the inquiry for imposition of anti-dumping duty has been initiated. Uh, Another change in the Custom Tariff Act is that they have introduced couple of new entries, tariff entries, which will come into effect from 1st April 2021. At the same time, they've also made certain changes in the tariff rate for certain classification for certain items that will come into effect effectively, and certain changes have been proposed which will come into effect from 1st January 2020, which is to align our Schedule 1 of Custom Tariff Act with the HSN 2022 proposed by the World Customs Organization. So that part will come into effect from 1st January 2022. Next, there are certain changes which have been made in the customs import of goods at concessional rate of duty rules. Number of customs notification are end use based, that is the benefit is made available subject to the condition that the imported raw material is utilized in the manufacture of certain specified items. So all such end use based notification, in fact majority of them, are subject to the condition that the importer follows the these customs import of goods at concessional rate of duty rules, IGCR rules. In these rules, there were several lacunas which a lot of importers were facing, and which was making the very condition of following these rules very onerous. The first lacuna which a lot of importers were facing is there was no provision which allowed the importer to send the goods on job work basis. So if you import goods uh, subject to the condition that you follow these rules, then you were required to put the goods to use, and you could not have sent the goods to a job worker. This condition was very onerous. Now they have revised the rule to provide that goods can also be sent to a job worker. It can be sent to a job worker under intimation to the jurisdictional custom authority. It can be sent for a maximum period of 6 months. So this is a very, very beneficial change which has been introduced, and this will help a lot of importers in availing the benefit of all such end use based notifications which are subject to condition these rules, and wherever they want to send the goods for job worker. Second important aspect which they have allowed is they have allowed 100% outsourcing of manufacturing to a job worker. Earlier, again, this was not allowed. Now this is also allowed. The third relevant and important change is many a times these notifications allowed import of capital goods at concessional rate of duty, or those were exempt, again subject to the condition that you follow these rules. But after some point of time, let's assume after 3 years, when I'm done using the capital goods have become obsolete, or otherwise if I want to transfer the capital goods, then in that case, the problem which used to arise is that the customs authority used to ask for payment of customs duty from the date from customs duty foregone at the time of import itself, along with interest, which was very onerous and irrational. Because if you import the capital goods, put it to use for 3 years, and then you dispose it off, and then at that point of time, if you are asked to pay the entire amount of customs duty along with interest, it is completely illogical and irrational. Now they have sought to rectify this problem also by providing that in all such situations where capital goods are imported subject to following these conditions, and after some point of time they are sought to be removed by the importer, the same can be removed on payment of customs duty at depreciated rates along with interest. So this again is a very welcome provision. The only two conditions which they are required to fulfill is, A, they need to take a permission, and it has to be at the calculation has to be made along with interest. So interest liability is still there. For depreciation, they have given a specific rates in the rules itself, which are akin to depreciation rates earlier provided by them at the time of clearance of goods from EOU to DTA. So these are very welcome changes. Again, this will allow a lot of importers to actually make use of all these end use based notifications which are subject to these rules. Now this part and the GST part will be dealt with by Ms. Shweta. I will ask Shweta to continue.
Hi friends. So I'll be proceeding with the AIDC Cess along with GST and some change in CST laws as well. And thereafter we will have the direct tax session. In the meanwhile, if you have any queries pertaining to the customs or AIDC, GST or direct income tax whatsoever, we will be taking up all those queries in towards the end. Towards the end, I will allow all the participants to unmute themselves, and accordingly they can raise their queries. But that will be towards the end. So I'll be proceeding with agricultural infrastructure and development cess first. This is effective. This has already become effective from 2nd of February 2021. This is levied only on the specified goods. So not all goods have been levied with AIDC, but only on specified goods at the time of import of goods. For the imported goods, as well as on the goods which are subject to excise duties as well. So, but for very, very specified goods. And this is levied on the transaction value. the value of the goods has to be calculated in the same manner as is calculated for the purposes of the customs duty. So whatever is my base for the customs duty, in the same manner, this AIDC will be calculated. For example, if my landed price of the goods is CIF value is 100 rupees, and for that, that is my base price for calculating the basic custom duty, then that same base will remain for calculation of the AIDC also. It will not be that it is calculated on basic customs duty or adding any other duties, but on the very base price itself. Because why I'm telling this is because this has been named as Cess. Cess usually on the duties and taxes, but this Cess is not on the duties and taxes, but on the base value of the imported goods only. Goods imported under customs duty exemptions available under FTA, EOU, and other under advance authorization schemes are being exempted from AIDC. So as I told you that this is only on the specified goods, and those specified goods are mostly the eatable items, alcohol, certain chemical items. Majorly, we can bifurcate them in these three types of categories. And if the goods are imported from the countries where India has FTA with the exporting country, or imported by an EOU, or if the goods are imported under an advance authorization scheme, then in those cases, they need not pay the AIDC also. So that means they can claim full exemption just like as now they are claiming. So if a importer is importing certain goods, say from Singapore, which is subject to the levy of AIDC, then in that case, since India has an FTA with Singapore, due to that, at the time of import, none of the duties, including the AIDC, would be applicable. Exemption from AIDC on import of goods from FTA countries, those are also very specified countries only. It's not that since India has FTAs with many countries, and there are also FTAs like SAARC and all, and which are bilateral in nature, but still it's only the specified countries from whom the exemption has been given. The specified countries are Korea, Singapore, ASEAN, Malaysia, and Japan. Apart from these countries, this benefit of exemption from AIDC is not available. So the question remains, what will happen to the imports from the other countries from whom India has, with whom India has the FTAs? If we talk about SAARC countries, in such scenario also India has FTA, but still if the goods which are leviable to AIDC are imported from those countries, those goods will be subject to AIDC, though will be exempt from BCD and other taxes. So in that case, because as of now, the exemption is only limited to specified countries, so the imports from other countries will not be given that kind of an exemption, even though they are having the certificate of origin and other form 1 as per Carotar and all in favor of them, but still they will not get the exemption from AIDC. Similarly, there remains a question open for other exemptions like a DFIA. Specific exemption has been given for the holders of advance authorization. So if an advance authorization holder imports the goods which are subject to AIDC, then in that case, since the basic custom duties and other taxes are exempt for him, in the similar manner, AIDC will be also exempt for him. But for the holders of for the exemption schemes like DFIA, in that case, though they will not be paying the BCD on the import of the goods, but still, because there is no exemption from AIDC for those exemptions, then in that case, they will be paying the AIDC on such imports. Important point to note in this is that though AIDC has been additionally imposed, still the overall rate structure, barring very, very few items, remains almost the same. So what the government has done is that in one part, they have decreased the basic custom duty and they have imposed the AIDC so as to make the total at par with what was being levied earlier. For most of the items, it's the same. There is no actual impact from importers' perspective. just some at some places there may be impacts, like I told you, where the FTA despite the India having FTA with those countries, they are subject to AIDC. So earlier they were claiming full exemption from BCD, but now even though India is having FTA with those countries, but BCD will be exempt and AIDC will not be exempt. So that much negative aspect will happen with the importer in such cases. So, but overall structure remains the same, more or less. Now we proceed on to goods and services tax. Before proceeding on to goods and services tax, I would like to tell that there are, though there are not many changes in GST, but still whatever changes they have made, they are quite significant, and which really and more stringent than they were before. First, we will be dealing with the CGST Act. The first change that I would be discussing is the change they have made in the definition of supply itself. So an amendment has been proposed to include any activity undertaken by a person other than an individual to its members or constituents, or vice versa, for a consideration. Why I am reading this language is because this language itself is very, very important. This is apparently, it appears that the like unincorporated body association of persons and other body corporates, those were the persons earlier who were put up in schedule 2, and whose supply of goods by the such persons to their own members was subject to GST by deeming it as a supply of goods. But now that schedule 2 entry has been removed and it has been put up in the main section, section 7. However, the wordings are significantly different. Earlier, they used to specifically say that unincorporated association of persons and the wordings like that. But now they say under any activity undertaken by a person other than an individual to its members or constituents, or vice versa, for a consideration. We will discuss why I have highlighted the word person also in this, and this will have a major ramification. We will be discussing the impact which this word person brings in. Secondly, I would like to mention here that this overcomes the decision of State of West Bengal versus Calcutta Club and others, wherein the Honorable Supreme Court had applied the principle of mutuality, and inter alia held that services by a club to its members amounts to services to self and would not qualify as a service for the purpose of levy of service tax. This was a Supreme Court judgment, and it was delivered in somewhere in 2019. And this effect, this change in definition of supply also, this amendment to section 7 has been done with retrospective effect. So basically this change has been done to overturn the judgment of the Supreme Court, wherein they hold something, and later on, which has of late become a recent trend for the finance ministry, later on by legislation, they overturn the complete judgment of the Supreme Court by giving it a retrospective effect to the amended provision. So this has been done in the same manner in this. However, let us now move to the definition of the word person. Person is defined in the GST law as a person includes an individual, Hindu undivided family, a company, a firm, limited liability partnership, association of persons or body of individuals, whether incorporated or not. You can see many, there are like a trust, every artificial, everything has been termed as a person in this. So now when we apply this definition to the term person, which has been given an amendment under section 7, then in that case, what is the legislation trying to say? Is it saying that any sort of service, any sort of activity, goods being supplied by the say a company to its shareholders, or a shareholders, because who are the members of the company? Members of the company are its shareholders. If I talk about partnership firm, the members of the partnership firm are its partners. So it does not only include any unincorporated association of persons, but it has very wide ramifications, specifically seeing that it includes company, firm, HUF also. So tomorrow if there is a Karta and there is an HUF, so what is the GST law trying to say? That the services provided by Karta to the members of the HUF, and the vice versa, the services provided by the members to the HUF will also be subject to tax. I really fail to understand, given the wordings which has been mentioned, though they actually seek to overturn the decision of the state of West Bengal versus Calcutta Club, because that was a Supreme Court judgment. And in fact, the legislation does this type of activity all often, overturning the decisions of the Supreme Court. But the Supreme Court is really heavily frowning over these type of things which the legislature does in overturning the decisions of the Supreme Court by making the retrospective effect. And similarly, the very important concept in this was the principles of mutuality, doctrine of mutuality, that itself is sought to be that itself is sought to be curtailed. So they're not recognizing the concept of mutuality itself, the doctrine of mutuality itself. What they're saying, that any services rendered by the members to the person or the persons to the members would be taxed. So when we say members to the persons and persons to the members, what does it really mean? It means if we four persons get together to do any type of activity, do we really say that the association is rendering any services to its members and the members are rendering any services to the association? That's completely flawed. Means those are actually services to self. It's just because few persons have got together to carry on certain activity in a combined manner. That does not make this rendering of any sort of services. And moreover, this type of provision was not there prior to this change. What was sought to be taxed earlier by virtue of Schedule 2 also was only the supply of goods by the unincorporated association to its members, and not anything else. But this change which they have made in the definition is very wide, very I would say badly worded, in fact. And it includes any type of activity. So this, according to me, this will again reach Supreme Court and again have the legality testing on this very provision. Next, we move on to the other changes. One very important change which has been introduced is the input tax credit availment. Section 16(2)AA has been inserted. The details of invoice or debit note to be furnished by the supplier in the statement of outward supplies, and the details to be communicated to the recipient. Till now, what was happening was that there was this GSTR 2A, 2B was also recently introduced, and whatever the if your supplier has uploaded the GSTR 1, then in that case those taxes used to those transactions used to reflect in GSTR 2A and 2B, and accordingly you were able to take the credit. But now 2A has 2AA has been inserted, and they say that it has to be furnished by the supplier in the statement of outward supplies, and the details to be, this will have much more ramifications to it. Some questions, this could be challenged before the courts also, because earlier in the VAT regime also, this kind of concept that if the recipient even though he pays tax, but he if the supplier has not paid the tax, then in that case how could he be subject to the prosecution under the act? So there was this Arise India Supreme Court decision earlier also. It's quite likely till now, 2A 2B was, everything was there, but this kind of mandatory provision was not there in section 16, which provides the conditions for taking of the credit. So in that case, it was maybe it was felt by the legislature that since this kind of mandatory condition was not there, then in that case people could really get away with actually not adhering to 2A and 2B also. But putting this kind of condition in the section 16 itself, I could foresee that this could see up to Supreme Court as well. Further, whether Rule 36(4) is redundant or not. The next question which arises from this is whether Rule 36(4), which allows me to take 5% additional credit on the eligible credits, will become redundant or not, or how do we really have to read that Rule 36(4), because now this condition being put in section 16 itself means that once I can see, once it is there in my 2A 2B, only then I can take the credit. So if it's not there, I cannot take the credit. On the other hand, we have rule 36.4, which specifies that you can take an additional 5% credit. So that additional 5% is nowhere reflected in my 2A 2B, which is actually an eligibility condition for me to take the credit. So whether it's in contrast with rule 36.4 or not, that really needs to be seen. Or maybe there is some sort of clarification on this which is issued. So earlier, in terms of rule 36.4, it was 20% additional benefit which was granted, which I could take the credit. Thereafter, it was reduced to 10%. Recently, last month itself, it was reduced to 5%, the changes which were effective from 1st of January. And now they have brought in this kind of condition in section 16, which would effectively mean, if we apply on transaction to transaction basis, that rule 36.4 becomes redundant, because actually now you are not entitled to take any further benefit. So why is the government coming up with such changes so frequently? That really needs to be seen. Third is whether this condition to be exercised before the assessment or at the time of taking the credit. In a sense, if we see on a plain reading, if we see that rule section 16 allows me to take the credit subject to the fulfillment of certain conditions, out of which one condition is that the supplier should have furnished the invoice, and that it should have been communicated to me. So if I have to take the credit, then that condition has to be first hand fulfilled. Only then I'll be able to take the credit. If we take this kind of interpretation, then definitely rule 36.4 becomes redundant. But if we take another harmonious interpretation, wherein we say, okay, those are the conditions for me to take the credit, but in any case, just at the time of taking the credit, or when I am actually doing my assessments, at that time I have to see the condition, then in that case, even if I take 5% additional and later on the invoice is uploaded on 2A 2B, then in that case rule 36.4 does not become redundant. So but as of now, we really can't say, in fact nobody can say that what will be the fate of this section 16 to AA, and how this will be interpreted. Maybe some sort of clarity is needed in this imposition. Next change which has come is that no requirement of statutory GST audit. Earlier, taxpayers having turnover of above 5 CR, they were required to have mandatory GST audit, which was to be done by the specified professionals like CS and CMA. But now this requirement has been done away with. There is no more requirement to get your accounts your GST returns audited. And now the only requirement that has been prescribed is the self-certified reconciliation has to be submitted by the a registered person. So if he himself submits the self-certified reconciliation, that would suffice. Third change that has been brought in annual return, though this is not really very important change, because this needs to be seen. Last date to file the return, that is 31st December following the end of the financial year, has been removed. The last date will be prescribed by the rules or notification. So as of now, the 31st December, which was the date for filing of the annual return, has been removed, but it will be prescribed by the specified rules or notification. Interest on net cash liability. This is important. Though this provision was made earlier, brought in earlier through the rules also, but now this has been incorporated in the Act, which says that interest liability on net cash liability is made effective retrospectively from 1st of July 2017. So earlier what the government did was they brought in a change in the rules. Accordingly, and thereafter they also brought a press release to clarify that this change will be effective from 1st of July, but nothing was done to regularize this provision in the Act. So now, by virtue of this finance bill, they have to regularize this provision. They have brought in this change. It is a welcome provision that if I am making any delayed, if I am furnishing my delayed return, and in that case, if I have any cash liability to be made cash liability to be deposited, then in that case this interest would be liable only on the net cash liability, not on the gross tax liability. There are certain provisions, severe provisions, which have been made for under section 129, which deals with the transportation of the goods without the appropriate documents. So there are severe provisions have been incorporated pertaining to detention, seizure, and release of goods. Section 129 has been dealing with any other provision related to penalty. Penalty has been increased from 100% to 200% of the tax payable. So 100%, earlier what was happening was there was tax was applicable at 100%, then penalty at 100%, and so total was 200%. Now that tax has been, the word tax has been removed, and total penalty has been made as 200%. Why this has been done is, earlier what people used to do is, when they used to pay the tax and penalty, then the since that was the tax portion which was reflected in the electronic cash ledger for them, at the time of making the actual tax payments in their through their returns, they used to utilize that amount. So the government, in, I don't know, I would not even call it that to secure their interest, but what they have done is that they have removed that tax portion and made the penalty as 200%, so that the person is now not even able to utilize that tax portion of the tax portion which is being reflected in the electronic cash ledger. Appeal to be filed against the seizure of goods only upon depositing 25% of the penalty amount. Earlier this provision was not there specifically for this penalty amount. Normal appeal provisions used to apply, wherein if you are making an appeal against any order, you used to deposit a pre-deposit of 10%. But now specifically for section 129, they have brought in a provision that if your goods are detained, if you are making if you are getting your goods released, and thereafter the appropriate authority passes an order against you for the payment of penalty and all, and you want to go in for appeal, then in that case 25% of the penalty amount will have to be deposited as a pre-deposit. When I say 25% of the penalty amount, this is penalty amount is 200%. So effectively it comes to 50% of the tax amount, if I would say that way. So I've made a small table, existing penalty and proposed penalty. This is self-clear that apart from the in exempted goods, there is no change. But if the goods are taxable, then in that case, for penalty and tax, it's only penalty that has been made applicable. Now I would take on to the IGST changes. Zero rated supplies to SEZ. This change has been made in section 16. Supply to SEZ to be considered as zero rated only when the same is supplied for its authorized operations. Earlier in section 16, this condition was not there. So therefore, which was typically meaning that if you make any supply to SEZ, that would be zero rated. But now they have imposed a condition that it will be zero rated only if it's for authorized operations. So for SEZ, they have a list of the authorized operations which they can do, and it also specifies the list of the services, the goods which they require for their authorized operations. So if these services or the goods which you are supplying to the SEZ are falling within that list, only then you will be able to claim the benefit of the zero rating of the supplies made to such SEZ. Though really not related to the budget, but it is also recommended that when you make any supplies to SEZ, it should be borne in mind that you get the consideration in foreign exchange rather than INR, because that will make you entitled for the drawback, also duty drawback, when you make supplies to the SEZ. This was a sometime I think around 1 or 1.5 year back or 2 years back around, this change was introduced, And apart from that, other benefits like that will also be counted in your advance authorization or EPCG also. If you get the consideration in INR, then you will lose on all those benefits, especially the duty drawback benefit, because that is one benefit which is neither you are claiming nor the SEZ unit is claiming. For the authorized operations, what the suppliers can do is that they can get some sort of declaration from the SEZ unit, plus they can get a copy of the LOP which mentions all the authorized operations and the goods and services which really are getting covered in that. So as a precautionary measure, they should get these things from the SEZ units and or developers, and accordingly then they should treat their supplies as zero rated. Now any supplies to SEZ will not be considered as zero rated. Second important change which has been made in section 16 is zero rated supply under LUT. Condition of realization of sale proceeds within a period permitted under FEMA. If payment is not realized, then refund amount along with the interest to be deposited with tax authorities within 30 days. This condition of realization of sale proceeds was initially made last year. It was introduced as Rule 96B in the rules, but it was not there in the Act. So many a times it has been seen that if the matters goes to court, there it is often interpreted like if the condition is not prescribed in the main statute, then the rules cannot prescribe any additional condition. They can only prescribe the method in which the main statute would be implemented, but they cannot impose any new condition. So to regularize that this sort of problem, they have introduced this very condition in the Act itself now under these in section 16. Secondly, they have also mentioned that if the payment is not realized, then in that case, whatever refund you have claimed from the authorities, you will have to return that refund amount and along with the applicable interest. And that has to be done within the 30 days. Next important change is that zero rated supply on payment of IGST. A zero rated supply on payment of IGST is restricted only to notified class of taxpayers or notified supplier of goods or services. Earlier, as we all know, that section 16 prescribed two methods of exporting the goods or services. One was under LUT and the other was on payment of goods, on the payment of IGST. So if you are exporting under LUT, then you were eligible to claim the refund of the input tax credits. And if you were exporting the goods on payment of IGST, then you were eligible to claim the refund of the IGST which you have paid on the export of goods. But now, this is a very, very important change. Now this condition has been removed. This facility of making a payment and then claiming a refund has been removed, and now the only option as of now which is applicable is on the supply under LUT, export under LUT. This, though it seems simple that okay, now earlier there were two options and now you're left with only one option, this really does not seem to be the case because it has many ramifications along with it. Let's see. One is the working capital cash flow issue. When I pay IGST on my outward, and the invoice and the GST return details used to match with the shipping bills, specifically in case of export of goods, then in that case, the refund used to come automatically within next 15-20 days. But now when we are saying that this option will not be available, then in that case you will have to apply, you will have to export under LUT, then you will have to apply for the goods also, for the refund also. And when you will apply for the refund with the authorities, they give their refunds on their own whims and fancies according to their own timelines, sometimes within 2 months, sometimes within 3 months, despite the fact that there are prescribed timelines in the Act, but still they do it on their own. So this will have a huge working capital cash flow issue, especially if we see like now when you used to export the goods, on each export you used to get the refund claim. But now definitely you would not be filing the refund claim for each export. It would be like, say, for a month or for a quarter or for 6 months, depending upon your credit, and thereafter the calculation of that 3 months or 2 months time to be taken by the government to process your refund claim will be calculated after that. So it will be a long drawn process. Minimum you can take it like 6 months minimum from the date, from the time you apply for the refund. So that phase, it will be really tough in terms of the working capital cash flow. Second is credit of inputs and input services only. Credit of capital goods gets stuck for the exporters. So when I pay IGST and then claim the refund of IGST in the shipping bill itself, because shipping bill is deemed to be the refund application also, I did not file any separate application in that case. So in that case, whatever credit I was having in my credit pool, that I used to utilize for payment of IGST, and accordingly the refund used to come to my account. But now when I say that I will be making the exports under LUT and then claiming a refund, the rule 89 specifically talks about the fact that it's only inputs and input services credit only which will be given to the exporters in such cases. It does not talk about the credit of the capital goods. So if you are a pure exporter, you don't have any domestic tax liability, then in that case this credit of capital goods gets stuck for the exporters. And this actually would mean that it's not only the goods that are being exported, but it will also incorporate some component of the tax paid on the capital goods also that would be actually exported, which is contrary to the very belief that only the goods should be exported and not the taxes. Third important repercussion that it would have is that credit only during the relevant period could be claimed. As I in the second bullet also I had mentioned that you could claim the refund, you could pay the IGST with any credit pool which you were having, which was eligible, maybe of the which was accumulated due to any reason, which was carried forward through Tran 1, which was due on account of capital goods. It could be any. But when we talk about LUT, then in that case, it's the language is so worded in Rule 89 that the credit which is being availed during that relevant period only will be claimed and not other credits. So these are very problems that could arise. However, the central government has been given the powers to notify certain categories of persons and categories of goods or services which will be eligible for on payment of IGST and then accordingly claim the refund. So we assume that they could come out with some kind of negative list, maybe, that apart from these persons, everybody else could claim, could export the goods under LUT and under on payment of IGST and then accordingly claim the refund. That could be known only when the notifications are out. As of now, they are not. Next is a small change I would discuss that has come up in Central Sales Tax Act, which is Section 8 was with certain provision of Section 8 has been amended, wherein it says that withdrawal of concessional rate of tax under Form C for interstate supply of goods used for telecommunications network, mining, or in the generation or distribution of electricity or any other form of power. Goods other than used in the manufacture of goods specified in Section 2D, petroleum and allied products. So I would rephrase it in simple words, like what was happening is that if my outward supplies are in GST, they are subject to GST, but I am procuring items, say petroleum and other allied products, which are subject to VAT. So even then, as per the decision of Carpo Power in Supreme, which was decided by the Supreme Court, which allowed me the issuance of Form C for petroleum purchases by businesses engaged in supply of goods under GST. So this benefit is sought to be curtailed through this amendment. So now onwards, I will now I will have to pay full VAT on these items, of which no credit is also available. And then because my goods are output is under GST. So the industries, the factories which procure huge petroleum items, diesel and all, for their working in the factories, they would be really impacted in this, and it will have a lot of transaction cost involved in this. There were many writ petitions which were earlier filed, and finally the matter reached in Supreme Court, and wherein this was decided. But now, to take away this benefit which Supreme Court had given, this amendment has been proposed. This is a very important amendment, though, which I have really wrapped up in very concise form. But this might impact many industries. Uh, this is as of now for the indirect taxes. Now I would like Dipanshu Gupta to present on the direct taxes. I will just for a moment stop sharing my screen and then share the direct tax slides with you. Yes. So now Dipanshu Gupta will take over the direct tax session.
Good afternoon, everyone. Hope the other two sessions related to indirect taxes, customs, FTP, GST have been very useful to all of you. Now we are going to cover the budget changes which have come up in the direct taxes, primarily Income Tax Act, as we do not have any wealth tax nowadays. So I'm just sharing, I'm just moving on the slide. We are going to pretty much talk about the changes which have come up in PGBP, taxation related to partnership firms, individual taxation, some of the quasi-judiciary setups which have been changed, along with the provisions related to return filing and TDS. Some of the other changes we'll cover later, including the Companies Act changes which have come up, wherein MC has even notified certain circulars yesterday and day before yesterday. To begin with, if I say one of the most important change which, or rather not a change which has happened, is that there is no change in the income tax slab rates for any person. Neither for individual nor for companies, AOP, BUI, partnership firms, HUF, like all the tax structure which has been settled or which has been framed in the last year budget and hence approved in Finance Act 2020 was kept intact. This means that the tax structure remains same. The surcharge, education cess, MAT rate, separate tax rates for companies, 115 BAB, BAC, BA, everything remains same. Let's move on to the actual changes which have come up. The first one, which is one of the most important change, which is here, is in respect of the depreciation allowance which can be taken on goodwill. So far, what used to happen is in case of purchase or merger and acquisitions, the goodwill is paid, and thereafter the entity can actually take the depreciation allowance on the goodwill which has been paid at the time of acquisition. Now the definition of block of asset has, goodwill of business or profession has been excluded from that definition explicitly. That change has been made in section 2. Along with it, the governing provision for depreciation, which is section 32, there also the term goodwill of business or profession has been removed. The overall impact of this is that whenever goodwill is there in the books of accounts, it will not be depreciated as such in the tax books. In your accounting books, you can still take amortization or revaluation of goodwill as such, but there is no deductibility in your tax books of accounts. Rather, what will happen is this goodwill will be taxed as capital gains at the time of selling of the business at a later stage. Therefore, the purchase price of the goodwill will be the cost of acquisition for the calculation of capital gain. Since this provision has been inserted with effect from 1st April 2021, this is going to be a change in terms of your block of asset as well. wherein both the gross block and the accumulated depreciation shall be removed from the block of asset. There should be a few more details which will come up in terms of how that will happen. Certainly, this is eventually overturn of the decision of Honorable Supreme Court in Smith Securities Limited, where it has been concluded that goodwill should be forming part of the assets, and depreciation allowance should have been provided on the goodwill as such. Moving to the next item, equalization levy was inserted a few years ago, wherein the term equalization levy 2.0 was framed last year, when 2% tax has been levied on non-resident e-commerce operators. This time, certain of anomalies which have happened in equalization levy have been fixed. This is the reason why these amendments have been made retrospective from 1st April 2020, when EL 2.0 was introduced. These changes are, the first one is the royalty and the fee for technical services. So it is explicitly provided that the royalty and the fee for technical services shall not be covered under equalization levy. It would mean that tax at 10% will be charged on royalty and FTS as per applicable DTA. Relief will also be provided. The next one is expanded scope of the considerations which e-commerce operator is supposed to cover. So over past year, we have seen different interpretation of consideration which have been explained by different e-commerce operators. Some of the e-commerce operators have been only charging tax on their portion of service. Now that consideration scope has been extended to include even if an e-commerce operator is owning the goods or not, even then equalization levy will be charged. And in a similar fashion, in the case of services, even if the services are provided by e-commerce operator or not, the equalization levy will be charged. For this purpose, the definition of consideration has been extended as well, which include 5 items in it, which pretty much is running from the Contract Act, wherein the acceptance of offer for sale is included. Placing the purchase order is also included. Acceptance of purchase order is included as the expanded scope of consideration. Payment for consideration is included, and supply of goods and services or provision for services, whether it is partly or wholly. So this would mean that equalization levy will be charged on the entire amount which is collected by the non-resident e-commerce operator. The third change which has been, or the third clarification which has been brought in place, is in relation to TDS. So there has been an anomaly wherein wherein the non-resident e-commerce operators were supposed to look forward for either the double taxation benefit or equalization levy. So that anomaly has been removed, and TDS will not be charged as such separately on this. Only EL will be charged. And all these changes have been brought retrospectively from 1st April 2020. Moving on to the next item, which is MAT provisions for non-resident, for foreign companies. So what used to happen so far is a foreign company, while calculating its MAT income, can take the benefit of capital gains on transfer of securities, interest, royalty, and FTS while calculating book profit for the purpose of Section 115JB. Now, when dividend income has been taxed in the hands of companies or in the hands of assessees, the same calculation should apply on dividend income as well, and therefore a provision has been inserted where it is clarified that dividend income which is credited to the company's P&L shall be reduced from the book profit for the calculation of MAT, and in a similar fashion the related expenditure shall be debited to the company's P&L. This is one. The second one relates to the past year incomes. So it happens several times that income of the past years have been included in the current year because of either APA or because of secondary transfer pricing adjustments. Now, in both these cases, ideally, these incomes should have formed part of the previous years where these income would have been generated, and therefore now the assessee has an option to file an application to the assessing officer for recomputation of its book profits of previous 4 years. The the limit of 4 year is actually being governed under section 154, wherein the application can be filed, wherein the 4 year limitation period will apply from the end of the year in which the application is received by the assessing officer. So this is a very important change, because otherwise the dividend income would have been taxed, would have not been included in the computation of company's MAT for a foreign company. The next one relates to relief which is provided to the buyers and sellers of residential units. There was a press release last year on 12th of November, wherein government specified and extended the limit of section 43CA, wherein safe harbor limit has been provided from 10 to 20%. So if I take a step back, in the last year budget in Finance Act 2020, there was a provision of extending the safe harbor limit from 5% to 10%. This means that any residential unit which is sold lower than its circle rate value, that in that case the property owner, which is the construction company which has built up the project, shall not be charged additional tax on the difference between the selling price and the circle rate. Now, before Finance Act 2020, that gap was available at 5%. In the last year budget, it was increased to 10%. The idea was to ensure that several of the operators who have a large unsold inventory with them, they are able to sell the inventory even when the circle rates have been increased over time, while the prices which have been agreed with the sellers have not. So now that limit has been increased from 10% to 20%. As I said earlier, a press release was was issued earlier in November 2020 for this purpose, and now the change has been incorporated in the Act as well. Note that this applies only for the transactions which happened till 30th June 2021, so 5 more months to go. And this is only for the first time allotment of residential units, wherein the sale consideration does not exceed 2 crores. When the sale consideration exceeds 2 crores, then the limit will fall back to 10% for the current year, as was approved in the Finance Act of last year. Also, in a similar fashion, this benefit has been passed on to the buyer of the residential unit under section 56(2), and therefore that will not be treated as his income separately. The difference between the circle rate and the actual price will not be treated as his income under section 56(2)(10). So section 44AA provides for the tax limit, provides for the threshold for the audit of any business or profession. Now, last year in the Finance Act 2020, this limit used to be a turnover of 1 crore for a business. For profession, the limit was 50 lakhs. Last year in the Finance Act 2020, this limit was increased from 1 crore to 5 crores, provided 95% of the transactions are digital, which is that not more than 5% of the transactions happen in cash. This includes, the term transaction includes both sale and purchase. So both money receipt and money payment, all of them should be in digital form, which is, cash should be less than 5% of the total receipts or payments. Now, this limit has been increased to 10 crores this year. This would mean that several of the entities who were earlier getting their audits done, and for them the due date for filing of ITR was 31st of October, that will fall back on 31st of July. So a lot of work of chartered accountants, which they feel now that is reduced because of the reduction in because of the increase in these limits, thereby reduction in the number of clients who would do tax audit. But on the other hand, their income tax returns would then be filed till 31st of July. So that's another change which is coming up here. Moving on to the next one. This is an important one which was even spoken by our Honorable Finance Minister Nirmala Sitharaman during her speech. So employees' contribution, the preamble of this change is that employee contribution, which is deducted by employer, is akin to a trust which employer gets into, and therefore it is employer's responsibility to ensure that he deposit that contribution to PF or superannuation fund or ESI or any other fund by the due date Now, up till now, the due date was always linked with Section 43B, which is the date of filing of return. And therefore, what happens is a lot of employers actually deduct the employee's contribution and doesn't deposit it or deposit it late, maybe like till the date of filing of return, so that they still can take that benefit as a deduction. Now, and this is on one side was related to employees' contribution. Then on the other hand, there was employer contribution for which Section 43 limit was always there. Even if the employer contribution was deducted and not deposited even till the time of filing of return, the benefit of deduction could have been claimed even after filing of return in the year in which the payment is made actually. So now, and there have been several case laws up to the level of Supreme Court, wherein it was settled that the payment is being made by employer, and therefore he should not be harassed or again charged by not allowing the deduction under Section 43B otherwise. The background, it's important to give this background, because now what has happened is that under Section 36, where the employer gets the deduction of employees' contribution to PF, superannuation fund or other funds, the time limit is shifted. There is the Section 36 is dealing with Section 43B here, which means that due date falls back to the original due dates which have been defined in the respective acts, either PF or ESI. So for PF, the due date is 15th of the next month. For ESI, it's 21st of the next month. Now, if the assessee employer does not deposit the employee contribution to the PF or superannuation fund or the ESI fund by the due dates as prescribed in those respective acts, and not by the income tax return due date, then he will not be allowed a deduction under this section. Now, one thing which is very important here is, though this change has been brought in the Act, we believe that this is very much litigative, and basis the precedents which have been set up in CIT versus Vinay Cement Limited earlier by Honorable Supreme Court, we feel that this might again be struck down soon. But till that time, certainly this disallowance will not be provided. This allowance will not be provided to employers who deposit the contribution of their employees late as per the respective laws of PF and ESI. So the next one is regarding the presumptive income section 44ADA. Now, this section was introduced 4 or 5 years ago, and the idea was to replicate what was there in section 44AD for the professionals as well. Now, section 44AD includes individual HUF firms and LLPs as well, while for some reason at the time of drafting 44ADA, LLPs have been excluded. One of the reasons why LLP could have been excluded from section 44ADA was there was a separate requirement of getting the audit done by LLPs in their LLP Act, wherein there was a limit wherein under section 34(4), the turnover, if the turnover exceeds 40 lakhs or if the contribution exceeds 25 lakh rupees, then LLP is required to get its audit done by a chartered accountant. Now, what has happened is it was always apparent that if LLP word is not included in section 44 ADA, they cannot take the benefit. However, now it is explicitly excluded from section 44A by including the words that it excludes LLPs. Now, one anomaly which still remains there in section 44 ADA is in relation to HUFs. HUFs have been included in section 44 AD, which is to say that they can perform or they can do businesses. So they can do business operations. However, as HUFs cannot do a professional service, that is actually done by a person and not by HUF. Ideally, the word HUF should also have been removed from section 44 ADA. So we hope that this change may come up in near future. Otherwise, it's just a redundant language within the section 44 ADA. The next one is related to slump sale. Under the slump sale, what used to happen so far is only a transaction wherein a transfer of undertaking happens by way of sale qualifies as a slump sale. While now the definition has been expanded, wherein not just by the way of sale, but by any other means, if a transfer happens, that will qualify as slump sale. Now, when this transaction will qualify as a slump sale, it will be taxed under section 50B on capital gains. Now, this section is effective from 1st April 2021, which is for assessment year 21-22. It is important to note that again, this section has been introduced, which will pretty much overturn the ruling of Bombay High Court in Bharat Bijli Limited, wherein the taxability of slump exchange was denied in the absence of monetary consideration. Now that will not be denied, like it will be taxed under section 242 and section read with section 50B. So for startups, last year, Section 80 Section 80 IAC extended the scope of coverage by one more year. This year also the coverage or the scope of this section has been extended by one more year. So earlier, if the startup was incorporated from 1st April 2016 to 31st March 2020, that was that was the period which got extended to March 2021 and now to March 2022. In a similar fashion, Section 54 GB, which provides exemption on capital gains when the proceeds from transfer of residential properties invested in the equity of any startup company, that has also been extended by one more year to 31st March 2022. Moving on to the taxation of partnership firm, there is one very important change which has come in section 45(4) and 4A. The earlier section 45(4) has been removed and a new section is introduced. Now what happens is when a partner retires or resigns from a partnership firm, he is being given a share either in the form of cash or in kind. And now that cash or in kind payment will actually be taxed to the firm. What will happen is that under section 45(4), in case of transfer transfer of capital asset, this should be capital asset here. In case of transfer of capital assets, fair market value of the capital asset shall be calculated, and that will be the full value of consideration under section 48. And for money or any other asset, the value of money or the fair value of the other asset shall be calculated. Now, it is still open as to how the value of other assets or the capital asset shall be calculated. So we believe that government is going to bring certain valuation rules for this purpose. Along with this, one important change is that if there is any balance in the capital account of a partner which relates to revaluation of assets in the prior years, that revaluation or self-generated goodwill or any self-generated asset shall not be included in the partner's capital balance at the time of retirement, and that will be taxed separately in the hands of firm. So that's one major change which is coming up for partnership firms. We now quickly cover the changes which have happened in the individual taxation. The first one is, yes, it's a welcome move wherein the senior citizens who are above 75 years of age, they are not required to file their income tax return. It's a very narrow definition which is given, wherein if they have interest income, if they have only one bank account, or if they have only one banking relationship with only one bank in which their pension comes in, any interest which they earn from that bank also, in that case, bank is being given power to calculate the complete tax which applies on that individual basis the declaration which he will make, and then they will deduct the TDS accordingly. Apparently, this is going to be a bit trouble for the senior citizens, because so far now they have not been they have not been required to pay advance tax. Rather, they actually pay tax at the time of filing return, while now their tax will be deducted as TDS only at the time of receiving of such income. So though they have been given benefit of non-filing of income tax return, but on the other hand, it's a very narrow definition which only covers interest income and pension income. There are several senior citizens who have other income as well, including rental income or any shares income as such, which is not covered here. So probably it will apply only to very limited number of senior citizens. Dividend income, advance tax on dividend income. So this has been, so last year dividend income has been taxed in the hands of receiver of dividend, as against DDT being charged by the company. Along with that, there is a anomaly which comes in from advance tax perspective, wherein if advance tax due dates have fall before the dividend is declared, then the taxpayer is not aware as to how they can actually pay tax at on the advance tax due dates. Now that anomaly has been fixed, wherein it has been mentioned that they need to ensure that they are meeting all the subsequent advance tax dates. Note that this is not applicable to deemed dividend under Section 222. It actually applies to the actual dividend which is received by the individuals. Moving on to the next one relating to LTC. This has been earlier introduced by our finance minister before in her press releases. LTC was always given on the actual expenditure. Now LTC can also be given in form of cash, wherein the specified expenditure is not more than 36,000 rupees, and it has been used for some of the expenditures on which GST is applied at the rate of 12% or more. Note that this only applies from 12th October to 31st of March 2021. For the next year, if this scheme is going to continue or not, we are not aware so far. ULIPs. So this is one major change which is coming up for HNIs, if I say. So far, the contribution to ULIP was exempt under Section 10DD. In the same manner, the redemptions from ULIP is also exempt. Now from 1st February 2021, which is on the day when the budget was presented, this is effective in the sense that those NRIs who actually buy ULIPs wherein the annual premium is more than 2.5 lakh in a year, in that case, they will have to pay tax on the redemption when these ULIPs will be redeemed. So this actually applies only to all the new ULIPs which have been purchased after 1st February 2021. And in this case, it is also important that this applies on aggregate basis on all ULIPs. So if someone tries to buy 3 different ULIPs of 1 lakh rupee each premium, even then he will be covered in this case. Important to note that at the time of redemption, capital gain will be taxed at 10% without indexation benefits. Interest income on PF contribution. This is again just to ensure that that high net worth individuals who are getting employee contribution to PF, which is more than 2.5 lakhs, they are taxed on accrual basis. There is no tax at the time of withdrawal, as was the case in ULIPs. But here, the interest income on the employee's contribution will be taxed at the regular tax rate applicable to that SSC on accrual basis. So this is only applicable from contributions which are made after 1st April 2021. So you still have time to invest as much as you want in provident funds till 31st March 2021. There is no limit which applies till 31st March 2021. Relief to NRIs. So this is one very interesting change which has happened for NRIs. Now, what happens is, if there is an Indian citizen who, if there is an Indian resident who goes abroad for work and retires in the same country and has a retirement benefit account as well in that notified country, wherein he was a non-resident in India at that time. Now, if he wants to come back to India, as of now, there are tax implications of repatriation of that overseas retirement account back to India. Government is introducing certain provisions wherein this might not be taxed on accrual basis but on receipt basis. More details will follow from here. Moving on to the changes which have come up in relation to the quasi-judiciary setup. Faceless assessment. Assessment was always there since a few years. Faceless penalty has been introduced. Faceless appeals have been introduced last year as well. Now faceless ITAT has also been introduced. Detailed guidelines will follow. So authority for advance ruling has been dissolved as the post of the vice chairman, the chairman, has been vacant for a few years now, as that has to be a retired judge of a high court. Since AR was not functional, that has been dissolved, and a new board of advanced ruling has been introduced. Interesting to note that the decisions of the board of advanced ruling will not be binding on neither be binding on applicant nor be binding on department. We believe that this is going to bring a lot of litigations as the aggrieved party may move to high court, be it the SSC or the department, so that is going to make a lot of cases up to the high court level as soon as the decisions of the board of advanced rulings will come out. So this board of advanced ruling will take effect from 1st of April 2021. Income Tax Settlement Commission has been dissolved. Again, there are this has been on hold for for a few months, rather a few years now, and after the dissolution of Income Tax Settlement Commission, all the pending cases, the applicants have been given an option to withdraw their applications either within 3 months if they want to do so, or then their pending applications will be allotted to an interim board. This interim board will consist of a 3-member bench, which will be nominated by CBDT, and the central government have been given power to provide the guidelines, the exceptions, modifications, and which they can make from 1st of April, from 1st of February 2021. Note that the power is given to central government only for the next 2 years, which is till 31st March 2023. Dispute Resolution Committee, instead of IT Settlement Commission, a Dispute Resolution Committee has been set up under Section 245 MA, which is primarily for small taxpayers, wherein the returned income is less than 50 lakhs and the amount of tax or variation in the tax is 10 lakhs or less. So this committee has power to reduce or waive off any penalty which is imposable under Income Tax Act. So probably this is going to be a big change for small and medium taxpayers if they want to go off from the legal proceeding and take the benefit of DRP. Income escaping assessment has been revamped completely, if I say this way. Now there was an earlier requirement. So there was an earlier process wherein the assessing officer can open the assessment for previous 6 years. That has been reduced to 3 years, only in case of severe information which they have in relation to the income escaping of assessee, which is more than 50 lakh in any particular year. The assessing officer can go back to 10 years and even in that case, he can go only to that particular year in which the income escaped is more than 50 lakh. If out of the remaining 7 years, there are only 2 years where the income escaped is more than 50 lakhs, only those 2 years assessment will be opened along with the 3 years which he has a right to open within Section 148. Also, in order to initiate proceedings under Section 148, there is a whole list of steps which have been identified for the assessing officer, wherein he can issue notice only if he has information which suggests that income has escaped. And this information, now CBDT has a good foolproof risk management strategy formulation through AI and all the information which they have over past years. So basis that only the assessment can be opened or the notice can be issued to the officer, to the assessee. Important to note that even for sending the notice, prior approval of PCIT or CIT level officer is required to be taken. Only in specific cases, inquiry and opportunity of being heard is being given before the issuance of notice, which will not apply for search or requisition cases. Especially for opening proceedings beyond 3 years for up to 10 years, the approval of principal CCIT is required. Changes in income tax returns. The due dates have not changed as such. However, some minor changes or some minor realignments have been made, wherein the spouse of a partner who was earlier liable to audit and as per Income Tax Act, the income tax return of the spouse also is being extended to 31st of October. In a similar fashion, if there is a partner whose firm is liable to audit under 92E, their income tax return date is extended to 30th November now instead of 31st of October. Also, one very important change which is coming up is all the assessment proceedings relating to section 139, 143, 144, 146, 147, all of them, including 153, all of them have been reduced by 3 months. So there are several provisions wherein the time frame was up to the end of the assessment year in which the return is filed, which is being reduced back now to the end of the financial year for which the return applies, plus 9 months as such. So this is one change which CBDT believes that is because they are more capable to handle the returns. However, I feel that with this, their time is not reduced. Rather, it is the assessee's times of filing the revised return or belated return which is actually reduced, because maybe CBDT might have all the AIs but not the assessee. Section 139(9), again, defective return. Assessee will be intimated and 15 days time is being provided. Now, CBDT has powers to waive off some of these conditions where a return is defined as defective return. So expect that there will be lesser defective returns which will come up in near future. Reduction in time periods. Again, intimation for section 43(1) is reduced to 9 months from the end of financial year. In a similar fashion, under section 153, completion of assessment proceeding is also reduced to 9 months from the end of assessment year. Again, I'm reiterating that pretty much the assessment by department is they have pretty much a similar time, because one, they have already been using AI, and second, when the time of filing return or belated return is reduced, they have their own 6 months in their hands to process the returns. So this is effective from 1st of April 2021. Another important thing is if this is effective from 1st of 2021, coupled with the income escaping assessment under section 147, that is going to have an impact on the demonetization which has happened in November 2017, because now what will happen is, from that date, the 3-year period would have already expired by 31st of March 2021. So we expect that department is going to finish sending all the notices by the end of 31st March 2021. These are the deductions which we have already covered before. One very important penal provision which is coming up now under section 281 is giving power of attachment of property in case the aggregate amount of penalty is more than 2 crores. So this penalty apply even if there is a false entry or omission of entry under section 271 AAD. So this is going to have a really big impact on the client and their consultants and their senior management of any company. Moving on to TDS provisions. TDS is like there are two major changes in TDS. I'm not going to cover these two, but the major changes in TDS which have come up is introduction of section 194Q, which is a reciprocal section of section 206C1H. One of the important thing is that since this is TDS, this actually applies to buyer and not the seller, and therefore the 10 crore limit which was there for seller in TCS section will apply to buyer in TDS section here. Similar provisions have been made that if any other provision of TDS or TCS is applicable, then this section will not apply, barring section 206C1H, which was introduced last year. So now it is important to note that if both these sections are applicable, then 194Q will apply and not 206C1H. The next one relates to, we have seen 206AA introduced a few years ago, wherein a higher TDS rate of 20% was introduced if the PAN is not provided. We have seen instances wherein the TDS is deducted, PAN is not provided, higher TDS is deducted, and still individual does not file their income tax return and forego the TDS which has been already deducted for them. Now there is another penal provision which is inserted, wherein a higher TDS rate of either twice of the specified rate or 5% will be deducted if the specified person has not filed their income tax return in prior 2 years. The same applies for TDS and TCS both. We believe that CBDT is going to provide a utility to identify who is the specified person who has not filed his income tax return in prior 2 years. This is not going to apply on non-resident who does not have PE in India, and therefore they are not really required to file their income tax return in India as such. Companies Act, 3 important changes have come up. The definition of a small company has been redefined, has been expanded, wherein paid up capital increased from 50 lakhs to 2 crore, turnover increased from 2 crore to 20 crores. OPC by a non-resident, wherein OPC by a person who is Indian citizen is been reduced to 120 days, then 182 days. Even NRIs are also allowed to create it. MCA is going to have a new version 3.0. Several other decriminalization provisions have been inserted the way they have been inserted in Companies Act before. Moving on to some of the other provisions, there have been significant changes in the corpus of in the taxation of corpus which has been received in charitable trust. We are really not moving on. We are just moving on from here in the interest of time. Disinvestments have been like demerger for banking sector units have been made, so that is going to have a big impact on sick banks which can still demerge and not are covered under capital gains. Cooperative banks have been restructuring have been done so that the cooperative banks can actually merge and or form a banking company. No capital gains will be applied on them. Several changes have been made in units in IFSC, including offshore banking unit and aircraft leasing. So these are the changes which have come up in the Union Budget 2021. Now the process remains the same, that these changes will be passed in the Parliament, and then thereafter they will be assented by the President of India, and only then they will be applicable, other than the ones which are